There are many things, many different topics on which investors disagree. But there is one thing everyone agrees on. Cash is trash. You shouldn't keep your wealth in cash. And this is because of inflation. Investing involves risk, but keeping cash is a sure way to lose money. It's not a question, it's a 100% certainty. So people ask me, inflation is coming, what should I do? The thing is, inflation is not coming, it's already here. There is inflation now and there was inflation last year. So it's not something new. This graph shows the purchasing power of the US dollar from 1913. This is inflation. Cash always loses its value over time. If you keep your wealth in cash, it will lose value. It's not a question. So what should we do to hedge against inflation? I believe that there are always two things that help us determine if something is a good investment or not. First, how that asset performed in the past, and second, understanding why it performed better than other assets. Many people say that you should buy gold to hedge against inflation, but it's already proven. Many statistics show that gold didn't perform well against inflation historically. Secondly, and this is the answer to the question why, gold doesn't care about inflation. Gold doesn't have a consciousness, it doesn't read the news to follow what is the inflation rate, and nobody controls the price of gold to follow inflation. On the other hand, we know from historical data that on average, stocks performed better. They had much higher returns than the rate of inflation. So now let's talk about the question why. Why is that stocks have higher returns than the rate of inflation? There are a few reasons why you can have a higher returns on stocks. We know that buying a stock makes us owners in a business, and businesses generate money. Gold doesn't generate money. The price of gold is only determined by speculation, supply and demand. There isn't any direct connection between the price of gold and inflation. Of course, we can argue that there might be a correlation between the price of gold and inflation. For example, if people think that inflation is coming, they buy gold, so the price of the gold goes up. But then it means that it's just a game of musical chairs. But we can choose to invest in businesses whose revenue growth is higher than the rate of inflation rate. For example, this is the reason that I buy dividend stocks that raise their dividends higher than 2%. Or if the dividend growth is not higher than 2%, the dividend yield should be high enough to compensate for this. And another thing is businesses can pass on inflation to the customers. If prices are going up because of inflation, companies can raise their prices so the inflation are passed on to the customers. For example, if the price of commodities like coffee go up, Starbucks can keep up with this inflation and build it into their prices. And sometimes companies raise their prices in a way that customers don't even realize. It's a very common practice to keep the price the same but shrink the product packaging. This is also called shrinkflation. For example, chocolate bars of well-known brands are getting smaller, or the bottle of Coke is getting smaller, but the prices are the same. Is this a shady practice? Maybe, but they are not wrong. Money doesn't worth the same as it was last year. If the price gain is the same as the inflation rate, then it's not really a price gain, not in real terms. If businesses were charging the same price year over year, the products would be cheaper and cheaper in real terms. And eventually, businesses would go bankrupt. So raising the prices is not some evil, greedy thing. This is how businesses work. This is how the economy works. So this is why keeping our wealth in businesses, in stocks, is the best hedge against inflation. They generate money with ideally more return than the rate of inflation. And they pass on the price gains to the customers. They have to do this by nature, otherwise they go bankrupt.